Welcome to another episode of Breakaway from the Rat Race. And today we have the pleasure of speaking to Kevin Bupp. Kevin is a Florida-based real estate investor, top iTunes podcast host, and best-selling author with over $250 million in real estate transactions. His extensive investment experience spans the gamut of apartment building, single-family portfolios, medical offices, self-storage, assisted living, and his three favorites by far: the most profitable mobile home parking lots and build-to-rent communities. And make sure you stay till the end because Kevin has a very special offering when he's going to offer his book for free. He's going to give us a special link. Make sure you stay to the end for that link. Kevin, welcome to the show.
Eric, I'm excited to be here. Thanks for having me.
Well, so there's a lot of different investment strategies that you're using here that I'm very intrigued by, that I've looked into slightly. But before we get there, how did you get started in as a real estate investor?
Yeah, that's a great question. I'll try to keep it somewhat short. I always joke and say that real estate found me, I didn't find it, and so very, very grateful for that pivotal moment in my life. More than 2 decades ago. So I'm 43 now. And, I went through high school, wasn't all that academically excited about, going away to school. It just didn't seem to be for me, but although I didn't know what I was going to do. And so I did what a lot of people do. I went to local community college, just started taking classes. I attended bar in the evening to make money. And, I've always been a hustler. I had a few small businesses when I was a kid, then I had a newspaper route, did whatever I could do to provide, not necessarily for myself, but I grew up in a very blue collar family. We never went without, but didn't have a lot of excess either. But as a kid, there was a lot of things I wanted. I wanted the best, bike. I wanted a dirt bike. I wanted toys and things of that nature. And so I very quickly realized that if I wanted those items, that I had to figure out how to either wait for Christmas and get like one gift a year, or like maybe one of those items, once a year, or, find a way to pay for it myself. And so fast forward to, I was graduate high school, went to community college, and just was kind of going through the motions, knew I wanted something bigger, but didn't know what that was. And I happened to befriend a gentleman by the name of David. He was a local real estate investor in my marketplace, and I met him through a girl I was dating at the time, and he was about 25 years older than I was at that point, and it was a completely new world for me. My parents both worked 9 to 5, had the normal W-2 job, and David seemingly lived a very different lifestyle than what I was used to. He drove a very different type of car, seemed to be around during daytime hours, which was weird to me, right? And just carried himself differently. I don't know how else to explain other than like it was just different than what I was used to growing up. And after a couple months of knowing David, seeing him over, he basically was dating my girlfriend's mother. So that's how I got to meet him. And so I would see him over at their house, and, we would talk, and we just became friends. And I didn't really understand what he did. I mean, he, contextually, he told me I own rental properties, and my residents rent for me. They pay me, I pay my, mortgage, and what's left over is mine, right? That's my cash flow. And that seemed very simple, and it kind of made sense, but I just didn't really understand how he ever got there. And, after a couple months of knowing him, he invited me to a conference. Again, just maybe he saw something in this. At that point, I was 19. This kid with no direction. Maybe he's got some ability, but he's not putting it to use. And I went to that conference with him, and that was the big pivotal moment in my life. And I came back and was excited, overwhelmed. And at that conference, I met people that were really didn't seem any different than I. They just happened to know something I didn't know, right? And they were making good money. This was a single family. Mostly, they talked about wholesale and also fix and flip, but these people were making significant checks, and wholesaling, making $5,000, $10,000, $15,000 wholesale fees, or doing flips and making $40,000, $50,000 profits. And that was just an eye-opening amount of money to me. It was an unfathomable amount of money to me. And I basically came back from that conference knowing that if I didn't figure out a way to put what I had learned in that very brief stint of time into action, and, that it would just fizzle out, and I would go back to the normal grind of going to school, not excited about it, and tending bar. And so I basically went to Dave with a proposal. I said, David, I would like to help you in your business, right? He was kind of a solopreneur, And I identified one of his weak points in his business, and he was weak with technology. And I saw him struggle one day putting together a PowerPoint presentation for an investor, and I knew that that was something I could help him with. So I went in with the idea of like, if I can help him in his business, in exchange for that, I just like to be around him more and just learn what it is he does, and ultimately, hopefully, that will give me some guiding light to get a better understanding of this business. And that's what I did. He accepted the offer. We became really good friends, and I basically worked for him for free for about a year and a half. And in between tending bar in the evenings, I'd work till 2:00 in the morning. The days I didn't have classes, I would, do whatever he needed in the field. I would go pick up leases. I would go to Home Depot for him. I would do whatever he needed. And then, and all the other times in between where I had free time, that's what I was doing. I was working with David in his business. And fast forward about a year and a half, I took the money I saved up tending bar and bought my first property, and utilized some of the relationships I had leveraged with David, some of his private investors, and help with the funding of the project. And that was it. That was at 20. And in my early 20s, I built quite a good model of typically wholesaling a few homes, keeping one, wholesaling a few homes, keeping one. And after a few years of doing that, I was able to establish enough relationships in my own capital that I could start keeping more and more of those properties. And in my early 20s, I amassed a portfolio of single family properties, of about 125 of them, I guess at the peak. Yeah. And then, just saw some different transitional points throughout the years of, for me, the big one was, efficiencies with that single family model versus buying some multifamily properties with more units underneath one roof. And so that was a big pivotal moment in my career. And so I started buying multifamily properties, and then realized that, there was maybe a bigger opportunity in just commercial real estate in general for me to, deploy more capital, do bigger deals, and ultimately see bigger checks. And so that was like the introduction to me to commercial real estate. And from that point, again, that was back in my mid to late 20s. And at that point, I knew that commercial was the way I was going to go. And so from that point forward, I've owned just about everything. There's other asset classes that I've owned that you didn't mention there in the introduction. I've owned, I think, just about everything. I'm sure there's some, random types of investments that I haven't, but for the majority, I've owned, different types of commercial real estate. But for the last 10 years, we really kind of found our stride with manufactured housing or mobile home parks. And so back in 2011, I bought my first mobile home park. We're still buying them today. We own assets in, I believe, at this point in time, 13 different states. We've put multiple different funds together, investing in mobile home parks all across the country. And then the more recent asset classes that we've really delved into, first one being parking assets. So parking lots and parking garages in very strategic locations, really looking at those as cash flow and covered land plays. Yeah. And then more recently, build to rent communities, and again, very strategic marketplaces. So, I've kind of run the gamut. We're still buying parks today. Still excited about that asset class, but equally as excited about parking and build to rent communities. So that's kind of again, condensed version. That's over the last 20 plus years. And I've been doing it full time ever since. I like to joke because I've never had a real full time job. Really, the only job I've ever really had was tending bar, and that's not a real job. That was a fun job, and I made good money for being 18 and 19. I made really, really good money. Met a lot of cool people, and it's just a cool experience. But never had a true W-2 job.
So really meaning David was really kind of like your rich dad, poor dad moment, right?
Yeah, no, it really was. That's a great way to put it. That's absolutely a great way to put it. He was he was an entrepreneur by trade. He didn't grow up an entrepreneur. He had a W-2 gig, but at some point he had a pivotal moment in his life where he was sick of kind of grinding. He worked in medical device sales and, had a successful career, but, started deploying some of his earnings into real estate, passive real estate investments, and found that was just a much better path for him. He enjoyed it a lot more, and it just gave him the freedom and flexibility that we all seek, I think, being entrepreneurs, right? I think that's what a lot of entrepreneurs that gets, build a business. That's one of the dreams they have, is to not be in the grind and be under the control of an employer that's saying, hey, you've got to work 60, 78 hours a week. That's my expectations of you, and you better do it or else you'll be gone. Right. Yeah. And so that's really what attracted him to that. And ultimately that was one of the big things I saw as well. Again, just comparing his lifestyle to my parents. They worked 9 to 5. We took one family vacation a year. My parents got 2 weeks of vacation total a year. And normally that second week of vacation they didn't really do much with it because we didn't have the money to go. I mean, like, it's just, they might have taken a day off here and there and used up the vacation time, but that was it. We stayed around the house. So, we didn't go to camps in the summers or do anything extravagant, but I had a great upbringing, but it was very different than what I saw in David's life.
Yeah, yeah, exactly. I mean, I had a similar experience as well. My parents was also very 9 to 5, paycheck to paycheck. They had 2 weeks vacation, and then that 2 weeks vacation basically went on a lake with a camper van or whatever it's called, like a tent, a tent or whatever, and went camping at that lake for a week or two, and which was like 45 minutes away from our house.
Yeah.
So that was our vacation,
which was probably a great experience, great memories, right?
Yeah,
I
it
mean,
was good.
yeah. It's but no, so like, again, I wouldn't change anything about my upbringing at all. I didn't have it hard growing up. My parents are still married, they're still together, and again, there was never a point in time where I was like, we're poor, or I might have said, like, damn it, I want, like, I saw one of the friends at school, they had like the newest, latest and greatest bike. I'm like, I want that. My parents were like, there's no way.
Yeah.
And so just that was like, okay, well,
Yeah,
they're not going to buy it for me, so I got to figure it out myself.
yeah. And for me, like, first of all, I thought that there was a disconnect. Like, a disconnect between the world they were seeing and the world I was seeing and the world that I wanted to understand. Like,
Yes.
banking, finance, all that kind of business. And there was a guy in our community, a very small town, and he started with like a truck where he was selling like hot dogs, hamburgers, and fries, and that's it. And then he built a lot where his truck was parked, and then he built a restaurant on that lot, and then he had another restaurant and then a candy shop in the mall, and he had like, that was crazy. And then I saw that, and I said, wow, that guy started with selling like hot dogs and hamburgers and fries, and look where he is now. And then my parents were like, oh, he must be cheating, or he's the mafia or something.
Right. That's it.
That's
funny. Like, it was a mysterious world to those that didn't come from it, right? And
you're telling me that somebody in the mafia is making hamburgers and hot dogs to clean money. So that doesn't make any sense. But that's the kind of thing, right?
No, I'm sorry. I was gonna say, I think it's also just a matter of, my parents were very risk adverse. Like I think in their mind, it's like, they always thought of like the worst case scenario being actually really worse than what it was, right? And so never really to taking the leap of faith to do something on their own or do something different, because in their mind, like, it probably would have been really realistically the worst case scenario. It was like 10 times worse, like, and so that it's just a different mindset and a different way of thinking about things. And again, just you're really considering the risk and knowing that, like, with this risk, there's seemingly a ton of reward, and I'm willing to take that risk to get the reward on the other side of it. So
I think the advantage that we had also, like, if you're 18, 19, 20, is like what? So what am I going to lose? Am I going to lose the $200 I have in the bank? Okay. So it's not, the risk is not as
that's funny though. You say that, but I remember when I bought that first property, I had $7,000 I'd saved up tending bar, which was a lot. Like, to me, like, that was a lot of money.
Yeah,
I don't think my parents had $7,000 in their savings account. Like, they just did. They probably, again, love my parents, but they probably don't have much more than that today. They've always kind of just followed that similar path. Yeah. And I remember buying that. Man, that was the hardest decision, because I literally took my account down to like a couple $100, and that was. I mean, my car payment was $120 a month. I didn't have a lot of like apartment and all that. Maybe I had $600 a month in total liabilities or obligations. And so, but still taking it down to next to nothing. Man, that was scary, because it took me a lot of slinging drinks, for late nights to save up that money. And so it was very, very difficult to part with it. And to me, I guess the worst case scenario was like, holy crap, if this doesn't work out, it's going to take me another year to ever save up that kind of money again, or a year and a half. Right. And like, that's time wasted. And so that for me was like the biggest fear. And but again, took the leap of faith, and it all turned out well. I'm glad it did. And surely some bumps along the way, but
yeah. So you wrote the book Cash Flow Investor. So why did you write the book?
Yeah, that's a great question. So I've, again, been investing now for 20 plus years, and I didn't reinvent the wheel when David kind of showed me his model, and his model was passive income, right? He managed his own property. So little deceiving, that it's not really passive, because I mean he dealt with tenants and things of that nature, but he always taught me about cash flow, like buying these properties, having your tenants, using your tenants to pay down on the debt, and ultimately owning these things free and clear at some point in time. But really, it was about the passive income, or the cash flow that was generated by each and every one of these assets that he owned.
Yeah.
And so, that's always, I didn't want to reinvent the wheel. That just made sense to me. Yeah. Like, great, let's buy these investments, let them pay for themselves, and have, extra left over at the end of each month that could allow me to live the lifestyle that I so choose. And so, just evolving that business model over the years. But then, on top of that, I've been hosting my real estate podcast for January would be 9 years, which is crazy to think. And I've interviewed some pretty phenomenal guests over the years, some incredibly successful entrepreneurs. And, my objective with those interviews has always been to extract, those golden nuggets away from them, just the strategic advantages of what they utilize within their business to grow and just kind of move away from the pack, right? Do things better than others. And so the book is really a compilation of not just my story, my experience with commercial real estate, but also the experiences of many others that I've interviewed over the years. And just, it's a compilation of all the above. And it really goes into depth in just the power and leverage behind just commercial real estate in general. But more specifically, I go into deep detail on a number of asset classes, two of which you mentioned in the beginning: mobile home parks and parking lots. Yeah. Those are two of my favorite. And then there's a couple others that I dive into as well. And it shows, those are maybe playing in the single family game, and there's no right or wrong here. You can make money a million different ways in real estate, but those that maybe want to do some bigger deals, it's kind of a guiding light to show them where they're at today, to not be overwhelmed or fear the unknown, but to, knowing that it's very doable, it's very feasible to buy larger assets, and along with larger assets, a lot of times come larger paychecks on the back end.
Yeah. I mean, definitely in terms of, especially if you do value add and stuff like that. I mean, it's much more efficient to do in a commercial building, because the valuation of the building is based on the economics of the building, the net operating income and the cap rate, as opposed to single family rental. You're always stuck into this comparable sales. It doesn't matter how much money you're making on the property.
I do think that's changed. It's interesting. That used to be I do think that's a valid argument. Although I think there has been a shift, especially given the turnkey model and all that. I think there's, even with the build to rent space, right? Build to rent never even was an asset class. Whatever, 5 years ago maybe it was, some people talked about it, but like now there's entire subdivisions that are being sold as packages, right? That are built as purposeful rental units. And so I do think that lenders, certain lenders are starting to take a different viewpoint, as well as investors themselves, as to valuing single family properties from a cash flow perspective than that of just comparable sales. But I agree with you for the most part. Although I do think there's some changing tide a little bit with how the value of a single family property might be viewed if it's used as a rental. So, with all that being said, the big thing I saw was when I wasn't married back when I started this business. I didn't have kids. And I worked my ass off to acquire, to build a rental portfolio. Like I said, I had about 125 properties at the peak of single family homes, spread throughout, 5 different counties. And I worked my ass off to find those houses over a number of years, right? It wasn't easy. A lot of direct mail campaigns, cold calling, bandit signs, all that old school stuff, billboards. And I worked really, really hard for years to acquire that portfolio. And I had some challenges during 2008 era, but leading up to that, I'd started buying some multifamily as well. And what I realized very quickly was that there was a lot of inefficiencies with the management side of those single family properties. And technology has made that a lot easier today. There's a lot more advanced technology that allows you to manage properties from afar, even single assets or single family homes from afar, than what existed back then. But still, even with that, there was a lot of inefficiencies that I could get rid of by just buying 70 units underneath, on one parcel of land versus 70 doors spread out amongst 3 different counties. And so I saw that there was an easier way, and I didn't necessarily have to work 80 hours a week to continue building this portfolio, and that, there was a quicker path to get there. And again, whether it be multifamily, other types of commercial, like that, to me, seemed to be the more efficient model to grow that business.
Yeah. I mean, we talked to a lot of investors. I mean, I have a turnkey rental business, and a lot of the people, they're just getting started. So for them to go and say, hey, I'm going to do a multifamily is just going to be, it's mind blowing. There's too much it takes too much time to do that. It takes them too much money. It's a bigger risk. And the single family rent, so they start with a single family rental. They get like 5, 10, 20, 30 properties, and then they decided they want to go into an apartment building after that. But
again, I don't think there's a right or wrong. I think single families are phenomenal. And I mean, we know that there's a massive shortage of housing in this country, and single family rentals have just outperformed for the last couple of years. And I think they will continue to outperform. And that's why there's these build to rent subdivisions that are being built. There's a massive demand for, standalone single family, properties that are specifically rentals. And so, I think everyone's got a different plan. Like, we have a lot of our investors they're W-2 earners, and they have no interest in quitting their job. They don't want to go buy mobile home parks or build a syndication company. They don't want to do that. They want to keep their W-2. They want to they either want to invest passively in some of the deals we're doing, and a number of them own, turnkey. They'll buy like 1 or 2 turnkeys a year, and they've got a plan. They say, hey, for the next 10 years, I'm going to buy 2 turnkeys a year. And I'm going to invest another 100,000 and maybe a couple other passive investments. And like by the end of 10 years, if all goes as planned, like that will be my retirement. And that's all I really need. I don't need to make $2 million a year. I don't need to have multiple employees. I don't that's not my plan. And this will allow me to achieve my goals. And so everyone's got their own individual goals, and you just got to find what is the best, most efficient path for you to obtain those goals.
Yeah, exactly. So I think it's a good way for people to get there. And you have multiple exit strategies. I mean, this with the single family rentals, I mean, if you want to convert it to owner occupied and something like that, I mean, you can up the rehab and then sell it as an owner occupied. You can do Airbnb in some locations, that maybe, or short-term or longer term rentals. You have a lot of different things.
I agree with that. Yeah, no, I think that it lends to a lot of flexibility. Plus the financing, right? You can't really, you can't beat, although rates are higher today, but you can't beat, 30-year fully amortizing financing on those types of properties.
Yeah. So that's, but right now, I mean, as you know, so I mean, you're a cash flow guy. So as you know, with the interest rates going up like this, our cash flow is, the cash flow is getting squeezed a little bit. So what are your thoughts on that?
Yeah, it's an interesting question, somewhat of a loaded question. I'm not sure I have the right answer, but I can just tell you how we're trying to navigate it. I mean, we've had deals that have fallen apart over the past 3 months because of the rising interest rate market. Seller expectations haven't adjusted according to what's happening in the debt markets, and deals that we started negotiating were in LOI stage. By the time we got under contract and started working through due diligence, the rate had gone up 100 basis points or 125 basis points, which could have killed them. Again, we had a couple of deals that died because of it. We have a couple of deals we're renegotiating now, trying to find the right baseline price that still works for seller, that seemingly pencils out for us. And so it's challenging, right? And I don't have the magic bullet here of how to navigate through it, other than only buy what makes sense, right? Like if your model doesn't pencil out because of the changing interest rate environment, and you can't get it at a price that does, move on, because there's going to be another time, there's going to be another opportunity to buy. And I will say that one of the things that we're seeing, in fact, I've got a deal right now that we're going to be closing here in the next 30 days. It's a mobile home park. It's in a phenomenal market. It's a Class A asset, stable property. And 6 months ago, if this would have gone up for sale, this would have fetched absolute top dollar. We would not have been a buyer. Like, we would not have been a competitive buyer for it at all. It would have been a hedge fund would have came in and bought it. And this guy, he kind of waited a little too long. And although when it came down to it, he still had a set price in mind. He hadn't really reset, not enough his purchase price expectations. However, for us, it's a price or terms. Like, now it's a multiple offer type strategy from our perspective. And he's in a position to where he can carry. He's owned it, and he's owned it. It's not free and clear, but enough to where we can pay off his underlying note, and he doesn't have a need for all the cash. And so we put forth an offer that got pretty close to his pricing expectations, but with some unheard of seller financing terms, especially given the interest rate environment, to where it's the 30-year amortization, 15-year balloon, 4.5% rate, 5 years of interest only, a 75% LTV. Like that was barely even possible in the best of times. And so and we don't have to think about anything. I know that I'm pretty safe that within the next 15 years, we'll find ourselves in a lower interest rate environment. Maybe never
Yeah.
lower than the 4.5%, but it
Oh,
won't be
no.
7% for the next 15 years. And so I feel comfortable and I feel safe. And with the terms that we set forth there, it's still it meets our investor economic model. It hits our returns, and we've got kind of a safe haven there with the underlying debt that's in place. So, and in addition to that, it's assumable. So if in 7 years we decide that we want to move on, and let's just say interest rates are still kind of high in 7 years. I don't think they will be, but let's just say they are. Now that underlying debt on that property actually becomes the asset itself because it's so attractive. It's assumable someone could step in and still have a good 8 years left of term, and they don't have to think about putting new debt in place. So
yeah, no, that's just very that's excellent. So yeah, and I think I mean I don't really have a problem with 7% interest rate, but as you mentioned earlier, I think it's how quickly it got to where it is today, and then the rest of the market, the rest of the sellers and buyers didn't really adjust to that yet. And I think that's kind of the problem is that if you look at the average interest rate, the 30-year mortgage for the last since 1970, I mean, the average is 7.7%. Yeah. So when you think about that, I mean, we're kind of right around there. I mean, I'm fine with an interest rate at 7% as long as the rest of the economy, the rest of the market is also adjusting. Sure. But this is very good. I mean, so often we talk about, if don't focus on the terms, don't focus always on, the price of the property. Just focus on the terms and how you can get the best financing and understand why the seller is selling, and come up with a deal that's going to make sense for the seller. So I think this is, I mean, that deal that you're talking about, I think this is fantastic. And I think it's very creative to really get to know the seller, understand what they're looking for, and what makes sense to them, and then organize a deal for them to that makes sense for you also. And then you can acquire these kinds of properties.
That's correct. That's good. I agree with you wholeheartedly. So, and I think there's other opportunities out there like that. I'm not going to say that everyone's going to offer you owner financing. You got to find, it's got to be the right seller. They got to have minimal underlying debt or no underlying debt. And, they have to be in a position where that's the best. That's the best. They don't have another use for the money. Maybe they feel like they're going to miss the cash flow. They don't want the headache of trying to, place that capital gain somewhere else, find another investment to put it in. And, this allows them to retain that cash flow without the headaches of actually overseeing and managing the property and mitigate their capital gains exposure. There's just, and I think hitting that point that you just mentioned is, you got to find the pain points of the seller, or just really what are their overall goals, getting to know them on a personal level. And sometimes they don't even know. Sometimes they truly don't even know because they don't know what all their options are. And so just having open dialogue with them and really, having exploratory conversations to find out really what's in their best interest.
Yeah, that's true. I mean, also, I mean, there's also some other things too that you can do, like with DST and all of that, to kind of like postpone the capital gains or something like that. So
that's correct.
So there's all kinds of different things, but most sellers that may not know about these kinds of I would say call them techniques, or so this is very good. So mobile home park. So how do you find your deals in terms of mobile home park?
Yeah, and I think and that's kind of what sets us apart, both with mobile home parks and parking. And back when I was buying single family homes, we kind of did the typical, maybe a little old school compared to what's done today, but direct to owner, off market direct to owner. We'd buy list, we would postcards, direct mail campaigns, bandit signs, billboards, wrapping vehicles, all that kind of stuff. Pretty traditional marketing methods. Nowadays, I think, probably paid per click and paid ads probably generate more leads than that of those old school methods, but really carried over, some of those techniques over to the commercial world and found it to be very effective. So, we built a proprietary database with a team of virtual assistants over a period of 7-8 years. That still works on that database today to keep it updated. So we, have identified, thousands of mobile home parks in certain markets across the country that are of a size and they're in a market that we would like to own in. And, we've got a CRM that, that we document all of our conversations with owners of properties, and we just continually keep in touch with them. Sometimes, for example, I got a deal under contract right now. We've been working on for 7 years. And when I say working on, I mean, we've been having conversations with the seller for 7 years, and he never had an interest, never had an interest, never had an interest. And I don't know. I can't really pinpoint the life event that happened or why he finally made the decision at this point to sell, but he's a seller now. And so I wouldn't say we were first in line, but there was a trust that was built over that period of time. We had never met in person until very recently, but we talked a lot. I knew his kids' names. He knew my kids' names and ages. I mean, just from past conversations. And that's how we find 90% of our deals. And so a little out of the norm for most people, I think, that are competitors in our space. Most folks kind of just simply rely on broker relationships, which is great. But I have found that, once it goes to the open market, once it gets in a broker's hand, I'm not going to be the only one that gets to look at it. We're very conservative in nature. There's probably a lot of deals that we could have made a lot of money on over the years that we've passed just because there truly wasn't a big enough margin of safety that I felt to take the risk. I'm very risk adverse after going through 2008 period. And so, but it's treated us quite well. Everything we buy below market value. We buy with a fairly significant margin of safety there. And I have to attribute all that to, having those relationships with property owners and buying direct to owner. So.
Any particular states that are better for mobile home parks than others?
No, I mean, the Sun Belt in general is great. Most of the Sun Belt are red states. And so, landlord friendly is always a good thing. With that being said, we've owned stuff in blue states, less than favorable landlord states. New York, we're no longer there for many reasons. We own stuff in Maryland, which is not all that landlord friendly of a state. But, Sun Belt, everyone, at the end of the day, affordable housing is a massive problem in this country. There's a massive net positive in migration to the Sun Belt states. And so we have found that, and then also on top of that, you don't have to deal with the weather. You don't have to deal with snow, and you have to deal with hurricanes here and there as we're got one bearing down on us right now when we record the show. But the Sun Belt it's just got the underlying fundamentals that really support our investment philosophy. And so we find that they perform the best. There's some markets out west as well, like Arizona and things of that nature that do quite well, but we're mostly east of the Mississippi and really honed in on the Sunbelt states.
Yeah. Are you seeing with the economy, the interest rate and all of that, are you seeing any kind of fluctuation on the mobile home parks or mobile home parks or build to rent? As far as pricing? The build to rent communities. So are you seeing
fluctuation in what manner?
In terms of demand for these kinds of properties or prices, are you seeing some pressure on the prices and stuff?
Yeah, I mean, as far as speaking to mobile home parks, I mean, the demand has been incredibly strong all through COVID. Thereafter COVID, again, we own most of the markets that we own in. What we offer, the product we offer, is the cheapest option to be in a good school district, to live in that respective marketplace. And so we never have an issue filling or selling a vacant unit when it comes available. It just has not been an issue again. But we're very strategic about the markets that we buy in, and we're very strategic about the actual assets that we're buying within that marketplace. Right? You can buy a great looking asset, but if it's in a terrible market that people are moving away from and doesn't have great schools, there's not a economic or a diverse economic job base there, then I don't care how pretty the property is. Like, you're gonna have a hard time attracting quality tenants. And in addition to that, there's a number of markets in this country that still are actually pretty affordable. Like that, they don't really have a demand for. There's not a huge need for affordable housing because housing is pretty affordable already. Like I always harp on Flint, Michigan, which anyone that's listening, no hard feelings. I know there's actually some decent parts of Flint, but generally speaking, you can go on Realtor.com right now or Zillow, and you can find a large amount of single family homes probably for $20,000 and $30,000 still, right? And so they might not be in the best neighborhoods, but there's affordable housing to be had.
Don't drink the water.
You could probably rent stuff for $500 a month too, I'm sure.
Well, I do, and in Michigan, I do just outside Detroit, so I do like a Hazel Park, East Point, and all of that. So which is like are pretty nice communities.
Yeah, Detroit's great. I mean, it's got a ton of phenomenal suburbs. Yeah, and I don't mean to harp on. We own stuff.
Right. But Flint has a little bit of a stigma. There's a little bit of a stigma. I don't know that they fixed the water yet.
Shame on the media for creating that negative stigma. Probably a more of a negative stigma than what's realistic, right? What's realistically happening there.
Yeah.
But yeah, and as far as on build to rent, no, the demand, if anything, the demand for the build to rent space has actually grown. So you've got this certain contingent of renters by choice, people that, especially the millennials are, forming households now. They're in the years where they're having children. And, for a litany of reasons, they choose to rent rather than own. They want flexibility. They want to move into something new. They saw their parents lose their house.
I'm a big proponent of them renting instead of buying and then investing their down payment into a rental property.
Yeah, absolutely. And so, but then also, so in addition to the renter by choice, now with the increase in interest rates and the reduction of buying power, those want to be home buyers got priced out of the market. Like they literally don't have the ability to actually execute and purchase a home. And so they're forced into the renter class, whether they like it or not. And so we've actually seen quite an uptick, even with rising rates, for the demand of quality rental properties.
Yeah. We've seen an increase also in rent for us. Rents itself and the demand for rentals as well. So even where we are, like in Cleveland and like I mentioned, like around Detroit and all that. So yeah,
I agree.
Very good. Well, so if people want to get a hold of you, where can they reach you?
Yeah, absolutely. So if you can reach me on my website, kevinbupp.com. There you can also listen to my podcast episodes. If you want to learn what we're doing in the investment space, both in mobile home parks, parking, build to rent, you can go to our company website, which is investwithsunrise.com. Eric, and as you mentioned beginning of the show, you can also grab a free copy of my book. You can see it behind me here on the shelf. You can either go buy a copy on Amazon for $20, or you can get a free copy by going to kevinbupp.com/free book. So
exactly. So that's the cash flow investor. Well, thank you very much, Kevin. Thank you for sharing your knowledge and experience in real estate and real estate investing. You have a great do you talk about in your show? Do you talk about these other alternative investment as well? Because I was also interested in assisted living also and all that kind of stuff.
So my entire show, I interview commercial real estate experts, but we hit all the different asset classes. So from multifamily to assisted living to self-storage to medical office to mobile home parks and a ton of niches in between there. So I bring experts on. I've had hundreds of them over the years on all those different asset classes.
Okay, great. Well, thank you very much. So make sure you like and subscribe and, follow Kevin as well, and see you next week.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.